Welcome back to JPX Energy Market Weekly Updates.
Crude oil prices have been under strong downward pressure for the past week, largely on concerns that the rate policy would cap demand growth going forward, while signs of seasonal demand slowdown accelerated the losses. Prices spiked higher in the wake of a massive Hamas attack on Israel Monday morning. There will be some risk premium factored in until the market is satisfied that the demand is not setting off a chain reaction. Front month's December JPX Dubai futures were trading at $84.30 a barrel. Inter-month spread were largely tracing the direction of flat prices, where prompt month and third month spread was last seen traded at $2.50 a barrel. With an uncertain picture on the oil demand, traders are searching for any clearer clues on where the market is headed. Fears of recession are showing up again, where the first clue comes from fixed income markets. Investors are betting the risk of recession is rising as the economy absorbs supply shock in the commodity and energy markets, and as central banks keep high interest rates for longer. Isn't nearly as much the short-term rate controlled by the Fed, leading to a so-called inverted yield curve. Historically, an inverted yield curve has been viewed as an indicator of pending economic recession. That has changed in recent weeks, with the longer-term rates, which influences rates for mortgages and other loans, rising faster, pushing the yield curve from negative towards positive territory. This particular run-up is mainly driven by a rise in real interest rates, which is because investors consider it riskier to hold government debt for the long run when the economy appears uncertain. It could also be contributed to the Treasury Department auctioning off more debt to cover the government's swelling budget deficit. For whatever reason, it could mean that much of the borrowing cost that affects the economic activity starts to bite across more corners of the economy than they have to date. What further dampened sentiment in the sell-off in crude oil market have proved not enough to prevent losses in oil product cracks. The drop was unusual considering heavy seasonal refinery maintenance, curtailing fuel production. For most of the year, oil refineries have been making huge profits from both gasoline and diesel, the industry's two mainstay products. Now the outlook for refiners is deteriorating, with gasoline profits collapsing and diesel margins inching lower, with further declines likely to crimp crude intake. It seems that the decline in U.S. implied gasoline consumption was one of the several bearish forces that came to the fore last week. EI report shows the U.S. gasoline stockpiles exceeded 5-year seasonal norms for the first time in 2023, tracking a 7% slide in the implied U.S. gasoline demand over the period to an 8-month low of 8 million barrels per day, while 4-week average gasoline demand at the lowest seasonals in 26 years. Asian gasoline markets have also been under pressure as cracks slumped on the Atlantic Basin. The weakness in gasoline has fed through weak refinery margins. The Singapore gross refinery margin complex dropped sharply to $4.80 a barrel last week, while the margins for cracking units, where most gasoline are produced, once turned negative. Diesel's premium over crude also fell to a low since July, and part is structurally lifted an export ban for its oil producers, but margins still remain well above seasonal norms. With the tendency to ramp up utilization and maximize diesel production, tightness in the diesel market might be mitigated, while gasoline may face further downward pressure in the absence of seasonal demand support. Looking ahead, as refining margins come off their highs, the first quarter of 2024 is projected by some to be the heaviest maintenance season ever, loaded with deferred work and regular scheduled turnarounds.
Okay, that's all we have for this week. Welcome back next week.